All right, hi everyone, welcome back. So today I'm gonna be talking about moats, and you probably seen this in many of the investment articles or Warren Buffett always saying you want to invest in businesses that have moats. So today I'm gonna explain to you what a moat is all about. Now, if you have the experience of visiting a castle back in Japan or in Europe, right, you often see that there's a very wide ditch surrounding this castle. Sometimes it's filled with water, sometimes it's just dry ditches. But the main thing is these ditches are usually super deep and super wide. And this is essentially what a moat is. The moat is essentially the ditch that is surrounding these castles. And back in those days, as a defensive measure, you want to have a first line of defense against your enemy. These ditches would be the first line of defense. Because when enemies come, they are going to retract the breach, and then in order to make their way through the castle to attack it, then the enemy will have to cross this bridge. So the wider, the deeper the moat, the stronger its defense, right? So when it comes to evaluating businesses, it is the same thing. You're always going to have your enemies attack you all the time, because something that is profitable will attract a lot of competition, because capital will go where profits are, where the returns are. So for businesses, in order to protect that profit margin of yours, if you want to be super profitable for a super long time, you must have moats around your businesses, or otherwise known as competitive advantages, to protect yourself against competition, which would eventually drive down returns. And as investors, we want to go for companies which have super wide moat, so that as investors we get to profit from these businesses' competitive advantages. So when we look at businesses, or like as consumers, when we go online to search for products such as a pair of white socks, if you were to just go online to search for a pair of white socks, right, you will see that the prices that would cost for a pair of white socks is super low, and more often than not, you can get a lot of options for below just $1. Why is that so? Because the internet has really given the power back to consumers, such that price discovery is super robust. You just go on to Shopee or Amazon, you type in white socks, and everything is the same. It is a commoditized product. Seller A and seller B and seller C, they do not differentiate much from one another. And so when competition sprouts about super easily, and there's no moat defending these businesses, they have to compete based on prices. And when you're competing based on prices, you don't get to you're not able to charge significantly above your costs of producing this pair of white socks, right? Then you just move on to companies like Nike, and then you search for a pair of white socks. Suddenly they're able to charge like 18, 19, $20 for the same pair of white socks, just because there's a swoosh on this pair of white socks. Now, why is that? It is because Nike has poured a lot of money into widening its moat, right, to defend against competition. It is able to charge significantly higher prices, like as much as almost 20 times what you have to pay for a normal pair of white socks, but consumers are still very willing to pay, right? Because it has associated the Nike brand with Just Do It. They got a lot of celebrity endorsements to come on board, so that when you buy a pair of white socks, or you buy a pair of shoes or clothes, you're not just buying a pair of clothing or equipment, right? You're associating yourself to these elite athletes subconsciously. And you see this often with very strong consumer brands like Hermes or Louis Vuitton. They are able to charge a significantly higher price, even though the cost of making these products is not as significantly higher as what you will see on normal market. But when it comes to having a strong brand as a moat, you want to choose companies who's constantly investing into growing their branding power, right? When you look at brands like Victoria's Secret, or Coach bags, right? They used to be super strong brands, right? They spend a lot of money into building this brand, but over time, because the management wanted to meet short-term Wall Street targets of increasing sales in the short run, they started to discount their product, diluting their brand at the same time. And often when you destroy or dilute a brand, right, it's super difficult for consumers to see your brand in the same light again. And very, very few, if not, I don't even remember any brands who diluted or destroyed their own brand being able to come back to command a premium pricing again. So when selecting companies like this, you want to make sure the management is not succumbing to short-term estimates, right? Discounting, making your product look cheap. You want to make sure that the companies they are investing all they can into making their brand stronger, because this is really important. Once you lose that premium branding, it's tough to get it back. Now I'm going to share two more of my favorite moats. Two of my favorite moats with you. So another one would be network effect, and you see this very often with companies like Facebook and YouTube. What happens is the more people you're able to attract to your platform, the more content creators will follow, right? Because content creators will go where the eyeball are. And when there's more content creators, right, and there's more users, the data on the platform works better, and the curation on your feed will be super relevant to you along with its advertisements. And this will likewise attract more advertisers on the platform, because when you're able to show very targeted advertisement, it leads to higher conversion rate, and at the same time, Facebook users would not be as annoyed when looking at this ad because it is relevant to what I'm interested in. So when that happens, when the data power kick in, when the network effect kicks in, right, it's going to attract even more people onto the platform, just because there's a lot of entertaining content, the advertisements are relevant, the things they are showing on my Facebook, on my Instagram feed is very relevant to my interests, and then more users is going to come in, right? When a lot of your friends are on that platform, Facebook, there's this chat function whereby it allows you to connect with your friends and family. More and more people are going to be onboarded at very, very low cost. In fact, Facebook, it doesn't cost Facebook anything to onboard you as one of their users, right? And likewise for advertisers, it's super easy for you to start advertising on Facebook. Like within 5 minutes, you set up an account, you set up who's your target audience, the age group, where they are from, their gender, etc. Your advertisement will start kicking in. So network effect is super powerful in a sense, right? The moat grows in strength as the networks becomes bigger, right? Because there's just more data, more users, more content creators kicking in, and the flywheel effect will just take over, right? It is tough to find a business that becomes better as they grow bigger, right? Most businesses, as you grow bigger, you start to become a bit sluggish, etc. Like generally, your competitive advantages will start to go down. But there are a few businesses which has this inherent advantage built in them, whereby as you grow in size, you become a much better business, right? Another example of company that when they grow in size, they become better, is scaled economic shed. This is another one of my favorite mode when I try and look for in businesses. So the best example of this is going to be Costco and Amazon. And scaled economic shed is a term that was coined by this great investor called Nicholas Sleep, right? So what scaled economic does is that as a company grow in size, right? When you see a retailer like Walmart, Amazon, Costco, as they grow in size, they are going to gain economies of scale, meaning costs are going to come down, right? Because your warehouse is just much more efficient when you are able to put a lot more products, and you are going to gain bargaining power over your suppliers. You are going to be able to negotiate for a much lower purchase price. And then what these companies do is that they pass all these advantages to the consumers. For example, Costco, right? They are famous for keeping their gross profit margin between 12 to 15%, meaning something that costs them $1 to make, they are gonna sell it to you at around $15 or $20, right? And they just keep it's their principle to keep passing back these cost savings to consumer. So as Costco continues to grow, right, their economies of scale benefits is going to kick in stronger and stronger. They're going to have way stronger bargaining power for purchasing land, for purchasing products. They're going to get better payment terms, and all these benefit when you return them to your consumers. Consumers are going to be super happy and super loyal, right? And when you have built a reputation whereby you are the cheapest place to find products, to buy products, you are going to get a lot of consumers in. I mean, after all, if there's only one thing we know for sure in retailing, it is not fashion, it is not what consumers currently are chasing after, the biggest fad, right? It is low prices. Consumers will always love low prices. And when that happens, you are going to get rewarded with increased sales, more customers, and they're going to purchase more. And in the end, you gain more power, right, over your suppliers and everybody else, in such a way that when all these powers kick in and you keep returning back to your consumers, you're just going to kickstart a very strong flywheel whereby things are going to get better and better over time, you know. And then it becomes very, very difficult for competition to come in, because who's going to have that kind of bargaining power over its competitors? They're not going to get as good a price as you, right? Consumers are not going to want to shop there because they won't, it's unlikely they're going to be able to offer as good a price to you, right? So these are some of the moats that I typically look at: strong branding, network effect, and also scaled economic shed, right? But it is definitely not exhaustive. There's a lot more other modes, like switching costs, for example. But we'll probably leave this for another day, right? So thank you for watching. If you like what you watched today, do go ahead and like and subscribe. This will go a long way to help me. Thank you.